Hey class, Mr. Vashon here. I'm going to make a video for you just in case this helps with review. I know some people have preferred the whole flip thing from the chapters 1 to 4 that we did, and we haven't been doing that since. Again, I'm going to get some feedback from you and decide which way to go moving forward. But anyway, I thought as we get into this review for the chapter 6 test, which is presently scheduled for Friday coming up, I could just take some time to make a video that sort of works like the videos you had before, where you can just look at this video and skim through anything you want to for content in case anything wasn't clear the first time or whatever. It's just here for you. You don't have to watch the whole thing. Feel free to skim to the parts or skip to the parts that you actually want to see. I'll just quickly mention test outlines here, practice test is here, so please check those out as well. So for this video, in terms of what you want to skip to, there are three main sections. Just like in chapter 6, there are three things we did. We talked about the general journal and just basic journal entries. We talked about source documents, and we talked about taxes. All right, and PST and HST are the ones we've been focusing on. So the section 1 is going to be the journal, section 2 is going to be source documents, and section 3 is going to be taxes. Again, feel free to skip. We've already been through it at this point. So whatever you need help with, focus on that. For this video, I've just basically thrown together not everything we've done, but sort of the key slides and add in a couple little extra things where it's appropriate. So this is almost like a straight up full content review of everything that we need to know, at least conceptually, with lots of examples for the test. Okay, so let's start with the general journal. So section 1, the general journal. General journal, whoops, I went full screen. I forgot I can't do that here. The general journal is a book or file where a firm's transactions are first recorded. The AFL quiz you wrote had a question where it's called the Book of Original Entry. Okay, the reason is because this is where transactions are first recorded, okay, before they're posted to the individual ledger accounts. Okay, so even though we did that first in the course, the book of original entry is called such because this is the first place. Transactions also, or sorry, a journal also has a nice effect of listing transactions by date, so it's chronological. Okay, so we want to get comfortable at this point with everything you see in yellow. What transactions are we should be good with from chapter 3. Journal entries, we should be comfortable from this chapter. And then the general ledger and the trial balance, we should be comfortable with from chapter 4. And this is how the accounting cycle starts. So we should be comfortable at this point talking about everything you see in yellow and why that's the case. When it comes to learning about the journal, we say a journal entry is just a transaction recorded in the general journal. So each of these are journal entries. All right. So this whole little chunk right here is one journal entry. This is one journal entry, et cetera, et cetera. Journalizing is just a verb we use for the process of recording the entries. How do you make a general journal? That's the big thing to make sure we review and are comfortable with going into this. So within an entry, the one thing I am seeing a lot of that we have to be careful with, or at least very diligent about, is indents. Anything that is debited, no matter what, is left justified, and anything that is credited is indented. So notice how this journal entry has two credits. They're both indented. All right. So credits are always indented. Debits are always not indented. I can't speak. Sorry, it's a little bit late. With respect to the dates, so we put down the month and the year at the top. The date needs to go every time. So even if both of these journal entries took place on November 9th, we'd put 9 here and we'd put 9 again. But you don't have to rewrite the month or the year unless either one of them changes, in which case we rewrite them where they change. All right, other than that, hopefully everything's pretty straightforward in terms of making a journal. We're doing a great job with explanations. You cannot forget the explanations. If you are lucky enough to have the source document name and number, we've agreed that you can just put that down and that is fine. The last thing I'd say about how to make journal entries is if you have multiple credits or multiple debits, the order you put that in, I've agreed that I'm not going to count that or have that affect you in your evaluation as long as everything's there and correct. I usually do them by order of magnitude. So I would usually put if there's 2 credits within a journal entry, I would put the bigger credit first. That's just sort of my general style. And I think that's pretty widely accepted, but it's okay if you don't. But what is important is within an entry, all the debits need to come first, and then all the credits for that entry need to come second. All right, and those are all the big things. The rules are restated here, so if you want, you can pause and take a look. This slide was also in an earlier slideshow, as most of these are. The opening journal entry is sort of the last little concept you need to know here. So the opening journal entry is so simple. This is the one that starts the journal off, or we might say opens up the journal. You might hear it like that. These account balances come from the initial financial position. So this journal, where do you think this journal might be? What month do you think this journal might be for? The answer is it's probably the journal for November. So to start off the November journal, we might take the October 30th, the initial balances off of our balance sheet, and we just straight up copy them down, the ones that carry over to the next accounting period, right? So more on that later, accounting periods, as we go through the accounting cycle, that'll become a little bit clearer. But for now, yeah, if you're asked to do an opening entry, just take the balances off the balance sheet for your assets, your liabilities, and your capital, and copy them down onto here. Okay, and that's the opening financial position of Shirley Cesar here. Same rules apply for journal entries, all the debits first and all the credits. And generally speaking here, just follow the order of the balance sheet for an opening entry. All right, so liquidity, maturity, and then obviously just capital can go there. So we're going to move on to part two now. Source documents. So for source documents, everybody's favorite. The ones we did in class, these 7 source documents, are the ones that are fair game. All right, now as I sort of mentioned in class, and I'll make it a little clearer here even, I like to put these 7 into 3 categories that to me are very logical ways to organize these 7. So invoices go into the first category, purchaser sales invoice. It's the same thing. It just depends on whether we're receiving the sales invoice as a purchaser or we're sending the sales invoice as the seller. Bank debit advice and bank credit advice, incredibly clear connection between those two. And then these 3 in the middle maybe aren't quite as clean and clear as the other 2 groups, but they all have that cash element to how they're recorded. So I'm just going to go over these ones. Each of them, I'll show you most of them, and we'll talk about how all of them are actually recorded in terms of the transaction. So number 1 is the invoice. So this is an invoice, whether it's a purchase invoice or a sales invoice, just depends who we are. If we're High Point, this is a sales invoice. You know it's their sales invoice because it's on their letterhead, right? So that means they're sending the invoice, which means that we are sending this to someone who owes us money. That's what an invoice is. An invoice is a record of you owe us money for in exchange for this or that, and this is how much is owed. You usually will have a date when it's due as well. Okay, so by just reading this, we could say, hey, it's an invoice because you can see what exactly it's describing. You know that the purchaser is Chelsea Electronics. So for if we're Chelsea Electronics, we would call this a purchase invoice, and if we were High Point, we call this a sales invoice. All right. So how would this be recorded? This was just straight out of our slides. This one. So in this transaction, if we were High Point and you saw this document, then here's how we'd record it. It's an invoice, so we know that accounts receivable has to be part of it, or account payable if we're the purchaser. So there's not going to be cash ever on an invoice. It's either an account receivable if we are the seller for us, or it's an account payable if we receive a purchase invoice, because that means we owe them money for the purchase. All right. Now, as for the other half of your journal entry, well, for a sales invoice, it's a sales invoice. So we're generally going to have a revenue account affected. So we can just say sales revenue. It could be fees earned or whatever. That would be our credit. And if it's a purchase invoice, it's not going to be revenue, of course, because we purchased something. Whatever we purchased would be our debit. All right. So if we purchased equipment, 3,800. If we didn't actually get an asset in return, if it was just an expense, like an invoice for telephone services or advertising fees or something, then we would just put telephone expense or advertising expense. That would be our debit. But our debits can be what we got in return. And yeah, account payable and account receivable are always going to be in an invoice because it's money owed. So I hope that all makes some sense. Invoices are quite straightforward. Moving on to the second category here. So the second category, we have cash sales slip, cash daily receipts, and check copy. So let's go through what each one is. I'll show you an example or two. So let's do cash sales slip first. So this is a cash sales slip. A cash sales slip is a source document just recording a cash sale that was made. Very straightforward. As you learned in chapter 5, a cash sale is one of the easier things to journalize. Let's say we're Masthead Marine. A cash sale means that a customer gave us cash in exchange for services performed. So we would have bank as our debit. Okay. And our credit would be whatever our revenue account is, maybe fees earned. All right. We just read the cash sales slip and figure out our credit, and then we just put the cash sales slip down. So cash sales slip, very straightforward in terms of what that means as a source document. The second type of source document that you might have is cash receipts daily summary, which can cause some confusion, but it's actually a very straightforward source document. So if you see this cash receipts daily summary, this is an ongoing record of, generally speaking, checks that we've received. That's usually why we have cash receipts daily summaries, because we receive checks. When you get a check, we can't actually keep the check usually. or it might not be practical to make copies of all the checks because we have to actually cash the check, right? If we receive it, because a check is basically cash, but we actually have to give it to the bank. So we don't have that as a source document. So what we do is we keep cash receipts daily summary. And a cash receipts daily summary is just a record of everyone who's paid us checks over the course of the day. So reading this cash receipts daily summary, here's what it says. It says that K. Dillon, who owed us money, has given us a check for $200. It says also on the same day, May 2nd, Kay Lau, who owed us money from invoice 8101, also gave us a check for 150. Globe Production or Produce, whatever the finish of this word is, that account receivable paid us back for 2 invoices they owed for these 2 amounts that you see over to the right. So it's just listing all the accounts receivable who have paid us back a check, effectively the same as cash, in exchange for the accounts receivable. So the journal entry here, assuming that we are Sing and Ming Supermarket, would just be, of course, bank, because they've all given us checks, and checks are just like cash for the total. So all these checks for today added up to 815. So we could just do bank once for 815.77. We could do a bunch of different journal entries, but that doesn't make as much sense. And then since they all owed us money and now they've given us checks, they all owe us a little bit less money. So we list as our credits all 3 accounts receivable. Okay, so Dylan, Lau, and GP, and those are our credits. Okay, and these 3 credits will add up to the 815 we received total in cash from them. So that's how the journal entry looks for cash receipts daily summary. If you have to do it, that's how it's done. Okay, it's just accounts receivable having paid us back checks. I didn't put a check copy on here, but that's the 5th source document. So a check copy is super straightforward. Checks are easy to read. They say who sent the money, who they sent it to. So first thing you ask yourself is who are we between the two? And that's telling you whether you received money or spent money. You know always that a check is the same as cash. So with check copies, you know that bank is going to be either debited if we received a check or credited if it's a check copy of a check we wrote. All right. And then whatever the other half of the entry is, just depends on what the check is for. And that's written on the check. So if it's a check and it says for services performed today, and this was received from a customer, then we know that we would debit bank because we received a check from a customer, and then we would credit fees earned. We would credit fees earned here if we received a check from a customer for services performed today. If it's a check copy, if we wrote a check to another business, then we're obviously crediting bank because it's just like paying them cash. And then our debit would be whatever we paid them for, expenses or in return for receiving an asset. All right. So again, checks super straightforward. And the last little category here of source documents, again, I'm just going through them slowly because this is an optional video. It's only for people who want to see them. So hopefully the pace isn't too slow. The third category, source documents, bank debit advice and bank credit advice. When businesses have bank accounts, they will sometimes get source documents from the bank. It's basically notice that the value of our bank account with, let's say, TD Canada Trust has increased or decreased due to interest. All right. So a bank debit advice is, as you can see here, it's the bank, in this case it's called the commercial bank, sending the source document to us, the company, which will also be written on there as well, letting us know that in the case of debit advice, our bank account has increased in value. Decreased in value. It's a little confusing because, yeah, it's a little counterintuitive. So bank debit advice means our bank account has decreased in value. And if it were bank credit advice, that's the bank letting us know that our cash has increased in value. Now, if you're doing sort of if you might mistake it, sort of like I just did, and say, wait a minute, bank debit advice, shouldn't our cash go up? Or bank credit advice, shouldn't our cash go down? The reason it's the opposite is because to the bank, our bank account, to the actual bank, the company, is sort of like a liability to them. So to them, it works in the opposite way. But anyway, in the case of either bank debit advice or bank credit advice, the reason why our bank account has either gone down or gone up is because of interest. So if it's bank debit advice, like you see here, bank debit advice, our bank has gone down, our account, so we know that we're going to be crediting bank. And our debit would be interest expense. Okay, if it is bank credit advice, which means our bank account has gone up, of course, very easy to get the first half of the transaction. If our bank has gone up, we know we're debiting bank. And here, the credit would be not interest expense, but interest earned. Okay, so it just depends on the nature of our relationship with the bank. Interest earned, for example, would just be by keeping money in the bank. The bank is using that cash that we're keeping there and loaning it out and using it to give people credit to go to school and to buy houses and things like that, right? So that's why, as customers in the bank, sometimes you actually earn interest. Okay, and interest expense could happen for reasons as well. Okay, so the big summary here of bank debit advice and credit advice is it's a change in our bank account due to interest. If it's bank debit advice, it means our bank balance has gone down. So we're going to credit bank and we're going to debit interest expense. And if we get bank credit advice, and you have to make a journal entry. Well, credit advice, again, a little counterintuitive. That means our bank amount has gone up. So we debit bank and interest will be the interest earned. So it's like a revenue credit. Okay, so I hope that all makes some good sense as well. I've also put in this nice little doc I found just on Google Images. This doesn't have all of the 7 source documents, but this has 4 of them. It's a nice little table just explaining what they are. And it's saying like what gets debited and credit in each case. The ones that aren't on here are cash sales slip, which is quite straightforward, and invoices, which I also think are quite straightforward. The trick with invoices, again, is it's just a debt, but just making sure we know, are we the buyer or the seller? And after that, it sort of takes care of itself. Okay, with a deep breath, Mr. Vashon moves on to the final part of this video on taxes. So, when it comes to taxes, in this chapter, there are other types of taxes that we haven't talked about. Like we did this in a warm up. We talked about how, oh, wait, there's income tax, there's property tax, there's all kinds of taxes that are collected by the government. But what we're talking about here in terms of accounting is sales taxes. So, these are taxes paid on the sales of goods and services. All right. Now, we start by, before even talking about Canada, we acknowledge that there's 2 types of taxes, 2 types of sales taxes, I should say. There's a retail sales tax, and in Canada, it's effectively our PST. And then there's value added tax. That's another type of sales tax, which is GST and HST. Some provinces have PST and GST. Ontario only has HST, a 13% HST. So Ontario's sales tax is a pure value added tax. And as we'll talk about here, the only difference really effectively is that value added taxes, if a business makes a purchase, not a customer, but if a business makes a purchase, no, not consumer, I should say, they can recover the taxes they pay. So businesses get their HST back, basically, is the difference. Whereas with PST, with retail sales taxes, with non-value added taxes, even if a business spends money, we can't get our PST back. We're just stuck. We have to just pay our PST. All right. So the 2 things we basically learned are how to do PST and HST. GST, we're not really doing transactions related to that directly just because there is one in Ontario right now. And if you know how to do HST, then you know the same skill as how to do GST. So just to simplify, we're not doing that. All right. So I hope everything I just said makes sense about what PST and HST are, and that big difference between value added taxes and retail sales taxes being that value added taxes can be recovered, or HST in Ontario can be recovered on business purchases. We just deduct it from any kind of tax liability we owe the government from the taxes we've collected from our customers, which we have to pay back. We would just deduct any HST recoverable then, and yeah, it keeps things hopefully, like to think, nice and simple in that regard. All right. Now, in terms of the differences between like just retail sales taxes and value added taxes, which I wouldn't say is the main focus of the chapter, or that it's super relevant aside from knowing that value added taxes like HST are recoverable, whereas retail sales tax like PST are not. Think about retail sales taxes as primarily, but not completely, applying to goods. We don't need to know any more than that. They can be applied to services as well, but primarily they're usually only applied to goods by governments, whereas value added taxes tend to be applied to goods and services. And the other difference between the 2 is just this nature of like when they're charged. So retail sales taxes like PST are really just charged on the final good, the final time a consumer buys it from a retailer, whereas value added taxes sort of apply more to business purchases. They can be applied throughout the cycle. So let me give you an example. So if I buy like a new Xbox 360 controller, that started with a manufacturer. okay, like Microsoft, if it was made by the parent company. And then they sold the controller that I eventually bought. They first maybe sold it to a wholesaler, which is a company who isn't actually selling it to me. Maybe they're just breaking bulk or doing it for ease of shipping or any other kind of value. But maybe it was already bought once here, and then maybe they sold it to a retailer like EB Games, So they're a retailer, okay? And then they sold it to me. So PST is retail sales tax is only charged right here at the end. The retailer, EB Games, when they sell it to the final consumer, it's only charged once, right? Whereas value added taxes, in theory, could be relevant at any point in this cycle. Okay, so if you were doing the accounting for EB Games, they might have bought it from the wholesaler. Okay, so if they bought the controller from the wholesaler, they still have to pay the 13% tax, but they can just deduct it ultimately at the end. All right, so PST is only applied to the end of the line customer. HST is going to be paid throughout, we might say, the supply chain purchases. But if you are EB Games paying 13% to buy it from the wholesaler, or if you are the wholesaler, again, paying 13% to buy it from the manufacturer, as long as you're a business, you can claim it and get that 13% back. All right, because the good is not done being sold yet. Each of these players is adding value. That's why we call it basically a value added sales tax. All right, we only need to charge the 13% once. When Mr. V, the customer, eventually buys that controller, I have to pay the 13% and I can't claim it back. For ease of accounting, it's charged every time, because otherwise, every time someone sells a controller to another party, they're not going to realistically check whether you're a customer or a business and go through that process. So it's just constantly paid and paid again, the 13%, the 13%, the 13%. But if you can demonstrate, and more or less if you are a business, you get to claim and recover that 13%. Whereas the person, Mr. V, me, can't actually claim it. So I'm the one who ends up paying the tax here. All right. I'll use that as a segue to get into the rules of accounting. Okay, so let me take a step back here and just talk about PST and GST. These are the rules we've been talking about. So for PST, which is a retail sales tax, 8% used to be in Ontario. It's different numbers in different provinces. I think it's mostly 8%. I'd have to check. But PST, when that's accounted for and purchased, here are the rules. Number one, PST is charged to the purchaser of the good. So if there's PST and you buy it, you have to pay it. Pretty much straight up. Sales tax is collected by the seller of the good. All right. So the PST is collected by the seller and paid for by the purchaser. However, the business doesn't actually get to claim this 8% they've added to the price of the good as revenue. It's not revenue. This is just us collecting the cash and holding it for the government. This is the government's money. And that's why we have to create this account called PST payable. And every time we sell something and collect tax from a customer, we're going to keep crediting PST payable, just like any liability account. And we call it liability because it's sort of like a debt that we're just holding for the government. And that debt gets a little bit bigger every time we make a sale. Okay. And rule number 4 is the business, the seller, at given points, usually the middle of the month, we remit this tax back to the government. In other words, we take all of our PST payable we've collected, and we just pay it. So we would pay the money, we would credit bank and debit the payable account to get rid of it at the end of the month. So I'm going to go through that as well, just at the very end. The last thing I'll talk about in this video is just a quick slide showing you how that remittance looks. All right, so let me just show you how that PST looks. So here's the example we did in class, and here's a little rule that we talked about. So from the purchaser's perspective, there's no special accounting for PST. All we do is if we buy something as a business, so imagine a transaction, the business buys something, and there's 8% PST. All we do is we add 8% to the cost of the good, and that is the new cost of the good. If there was no tax, the cost of the good would be less, but since there's 8% tax, the cost of the good is the price plus 8%, and that's what we have to list it as. Okay, so for example, if we, the business, bought something worth $1,000 plus 8% PST, and let's just say that we paid cash. Okay, what we would have to do is, let's say we bought equipment, we would debit equipment, of course, because we just bought $1,000 piece of equipment. But the value of the equipment isn't actually $1,000 because it cost us 1,080. So when we pay that business, our cash, our bank, of course, as you know, just as people living around and having paid taxes yourself, you have to actually give that business 1080 in cash. So this is what our journal entry looks like for PST when we purchase something. It's just very normal, very straightforward. There's no extra account. There's no PST recoverable because you don't get PST back as a business. That's the difference between PST and HST. You just take the money and you add it to there. All right. However, with PST, let's say we're on the other end. Let's say this is a business sale, not a business purchase. So let's say the business, we make a sale of $200 to a customer, 8% PST, and again, let's just say it's cash. In this case, well, what would we do? Well, we made a sale to a customer for 216 in cash. So we receive cash, or I should say bank, for 216. 200 plus 8% is 216. However, we don't get to call all of this fees earned. We haven't actually earned $216. We've only earned $200, and the other $16 we're just holding on to for the government. So we add that to our PST payable account, which is a liability, of course, because we're going to pay back the government later. So this is what the transaction looks like when we sell something. Okay, with tax. It's the same thing for HST, by the way. If we sell it for HST, we would just say HST payable instead of PST payable for whatever that number would be. HST would be a little bigger because HST is 13%, but that's how a sale looks. All right, here's another example to show you on the slide. I won't go through the whole thing, but this is the one we did from class. All right. What is on my screen? Okay. Anyway, so this example right here is a $500 cash sale for a computer with 8% PST. I don't know if I can only see that or if you can see it too. It's Chris Como real time. Okay. Anyway, so here, computer equipment. Let me pause and see if I can get rid of that. I think I did. So here, again, straight up $500 sale for cash. So if we're the purchaser of this equipment, so if we are bread and butter, since we bought it from Ace Corporation, as you can see, we just add the 8% PST. So the cost of this computer to us is actually 540. So that's what the computer is worth on our balance sheet. It's going to be 540. So we debit the computer for 540, and since we paid them cash, we credit bank for 540 because we had to pay them both the 500 plus the PST. So there's no special accounting for PST when it's a purchase. We just simply add the 8% and the numbers change, and that's it. But when we sell something with PST, just like with HST, if we're the seller, so Ace Corporation, obviously, if bread and butter gave us not 500 cash, but 540 cash, well, since we collected cash of 540 from the customer, obviously we still debit cash for 540 because we just added 540 to our bank account. But we can't just say sales revenue of 540 because only $500 of this 540 we collected is ours. The other 40 is PST payable. All right, so I hope that makes sense. HST is sort of the last real concept here in this chapter, which is a value added tax, which is the same as a PST, except if we're a business that spends money on something with HST, we can recover it. We get it back. With a sale, it still works the same way, but if we make a purchase, it changes a little bit. So here are the 4 rules again. The bolded parts are new. All right. So if the buyer is a business, the business keeps track of the HST charge on its purchases in a separate account. We don't need to keep track of the PST we spent on purchases as a business because we don't get PST back anyway. So there's nothing else to keep track of. But with HST, we're going to get it back. So obviously we want to keep track of it. That way we know how much the government's going to basically effectively owe us in HST recoverable. Okay, sales tax is collected by the seller still, and just like with PST at the end of the month, any HST that we've collected from customers, we have to pay back to the government, except with HST, anything that we have spent on purchases, we just subtract that from the HST payable to get the new number. Okay, so I'll try to make that a little bit more clear. So I'm throwing out these terms here, like HST recoverable. HST is applied to goods and services. PST is primarily applied to goods. PST to services sometimes as well. So it's not super relevant. It's just something to know. When a business makes a purchase, it records these amounts in an account called HST recoverable. Okay, so when a business pays HST, again, we get it back on our purchases. Okay, so every time we're going to debit HST recoverable. We debit it because it's almost like an asset, right? It's money that we had to spend, but we're going to get it back because we get to deduct it from our HST payable. For that reason, HST recoverable is something we call a contra account. contra liability account in this case. A contra account is a smaller account that tends to offset the value of a larger account. So I'll show you that in a second. HST recoverable is used to offset the tax liability from HST payable. Okay, so HST payable, rather than paying the government back all the HST payable, we pay them back the HST payable minus any HST that we get to recover from our purchases. All right. Here's how that looks. We went through this picture as well. So I want you to imagine here a balance sheet. If it helps, imagine assets up here and our equity section down here. And this is just the liability section in the middle. So you have normal liabilities like accounts payable, like bank loan, maybe mortgage payable or something could be below as well. And then you have this account payable called HST payable, right? Because if at any given point we owe the government some money from all the taxes we've collected that we haven't got a chance to pay them back yet, because maybe we only pay them back once a month, we always have to list that as a liability. So if our HST payable is $2,600 over the course of the month, we list that as HST payable. But notice that even though our HST payable is $2,600, from what we've collected from customers from our sales, this business has also spent $650 on HST in our purchases when we bought things like equipment or paid expenses like telephone or whatever through our purchases. So how much does Brookswood Driving School actually owe the government? We only owe them $1,950, right? We don't have to pay them back the full $2,600 we've collected from our customers because we can just deduct the HST that we get to recover from our purchases. So I hope that makes sense. And I'll show you sort of how that will look in a remittance in a few moments. And at this point, just go back to an example from the slides of how HST transactions look. In the case of this transaction, we have a situation where $4,000 was paid in a service charge and 13% has to be added. So I'll show you what this would look like as both the purchaser's journal entry and the seller's journal entry. So as a reminder, we have a $4,000 sale. This one's on account, sale on account. That's why you'll see account payable and account receivable in their journal entries for these two companies instead of cash. And it's 13% HST. So we're going to need to add that and figure out how it looks. So for the buyer of a sale like this, so if the business spends $4,000 on something, then for us as a business, the expense, unlike PST, where things would get added together and there was no PST recoverable, instead of having to put down 4552 or 4520, sorry, which we would with paying PST, luckily we're paying HST, which is a value added tax, so we get to recover the HST that we spent here. So yes, as the purchaser, the purchasing business, we do owe corporate caterers 4520. Fortunately, only 4,000 of that is our expense, and 520 of that is recoverable HST that we'll get back later by deducting from our HST payable. And from the sales perspective, if there's a sale with HST involved, notice it looks the exact same as a sale with PST, right? So let's say we make this sale here. The customer owes us money. They owe us 4520, so they owe us both the revenue and they owe us the tax. They have to pay us both. So that's the account receivable for 4520. But only 4,000 counts as our revenue, and 520 of that we now owe to the government because that's the taxes that we have to effectively pay. Okay, so hoping all of that makes sense. Let me wrap up this video by just showing you what happens at the end of the month. So just as a reminder, here's what the balance sheet kind of looks like, right? Where we have HST payable less HST recoverable. This is the one we did in class. Thank you to the person who reminded me to put brackets around less HST recoverable. That looks better. This business, let's say this one right here, this business only actually owes the government $3,000 in HST, right? Because we've collected $16,000 in HST payable from our sales, and from our purchases this month, we're able to recover $13,000 that we ourselves have paid in HST because we're a business and we get to recover HST. So $3,000 is actually all that gets added as a liability. So let's say the month is over and it's time to pay the government this $3,000 that we owe them in net HST, right? So here's how it would look. Okay, it's for the same company. So obviously, if we're paying back the government $3,000, we know that we have to credit bank $3,000 because we just paid the government back $3,000 cash. Our cash goes down by $3,000, and then what we do is we effectively eliminate the two HST accounts that we have. This HST payable for $16,000 up here, it disappears, right? Because we've now given that money back to the government. And we've subtracted the HST recoverable, so that's going to have to disappear as well. HST owed would disappear also, right? So since this liability account, HST payable, is disappearing, as you can imagine, that means we debit HST payable for $16,000 because that's what we do when we pay back a liability. And HST recoverable, which we've been debiting every time we make a purchase where we get to recover the HST, so it has a normal debit balance of 13,000. We're getting rid of it, so we credit it. So basically, just do the opposite that you normally do to HST payable and do the opposite that you normally do to HST recoverable. Effectively, this is going to push the value of these two accounts down to zero, and we're also going to get rid of 3,000 in bank, and therefore we're all square with the government. We're all paid back on the HST. I just give you another example down here. If it were PST, let's say there were no HST and you had to remit your PST payable that you've been collecting throughout the month. This is even easier because since there is no PST recoverable, all we would do is pay back the government. If we had 26,543 in PST payable, obviously our bank account would go down by that number and our PST payable would disappear because we're paying back the government, we're paying back the debt we owe, so we would debit that, right? Just like up here, we're debiting HST payable in the case of remitting it back to the government. All right, thank you for sticking with this video. Obviously, it's very long. Again, that's my intention. I want to make sure I went through things at a good pace. I know we've been through everything here in class, but again, just so you can have this record, this video, in case you do want to watch it later, hopefully it'll help even one person. I'd be pretty happy with that. But please let me know if anything in here was unclear. If you have any questions, I always appreciate you telling me. Okay, so thanks everyone. I'll see you in class. Yay.